Okay, chapter 11, monetary policy. We've been talking about this for the past hour and a half. Monetary policy is essentially the manipulation of the amount of money in the financial system in the economy, given shocks to the system. Black swan events. Your discussion this week asks you to introduce a black swan event. I hope I'm not boring you guys. Black swan events. These are things you could not forecast. What do economists do? Build models. A model is a simplified version of reality. Why do we create these models? To predict. Predict what? The future. And then the black swan comes. You could not predict. You could not predict COVID. That was unpredictable. These things happen, unpredictable events. So what happens? There are two policy instruments the government has. They have two policy instruments. They can either spend more government expenditure on COVID relief funds, that kind of thing. Emergency check. I forget, CERB in Canada. The government can spend. When the government spends, more money is, the government spends, remember, $1 spent is earned and spent several times. That's next week. Fiscal policy, more spending by the government. This is monetary. What it's doing is it's manipulating interest rates. Interest rates go down, that means more money in your pocket, you're going to spend more. Because what's the sense in putting the money in the bank if interest rates are down so far? So when interest rates go down, the government wants you to spend more, invest more in your future. Right now, it's changing. Interest rates are going up because the economy is overheating. There's price pressure on the economy. You've heard it. You've heard it. What's the number one indicator that there's price pressure in the economy? What do you read about? From your perspective, from the working person's perspective, what has been changing in the past year that suggests that there's positive price pressure in the economy? What did they increase last year in the United States to $15 an hour? Oh, minimum wage. We got that. Exactly. And you're hearing the Great Resignation right now. People got locked in their homes, and then they decided, I'm too old for this. I'm going to Mexico. I've got an okay pension and some savings. I don't need this kind of aggravation. I know at least 5 people, 3 people. But I know a lot more that are thinking about it. Get out of here. Positive price pressure. As soon as the price pressure starts to, here's the thing. We looked at MV equals PY. So the amount of currency times the number of times that it is spent equals your output. But that P, that's the price pressure. What happens once it starts to to increase, and they start implementing a monetary policy to slow down the rate of increase, because that's what monetary policy is doing. On Friday, they increased interest rates so that they could slow down price pressure. But when did they get that price pressure data? 3 months ago. What's it been doing since? Has it been increasing? Has it been increasing at a constant rate? Has it been increasing but slower and slower and slower? Do you know? I don't know. And yet on Friday they increased interest rates by 1%. You start to see how tricky it can be to implement a policy. Monetary policy can be done very quickly. The problem is it takes a long time to actually work its way through the system. Yeah, so interest rates went up 1%. Does that mean you're still not going to try to get a mortgage on a house? No. It's really, really tricky what we're about to talk about. How it actually works is really, really tricky. Milton Friedman, Chicago economist, very famous, said inflation is a monetary phenomenon. In other words, why do we get inflation? Because there's too much money in the system. What's been happening over the past 2 years? What would you say has been happening to the amount of money in the system in the past 2 years or around the world? Increasing. Has it been increasing at an increasing rate? Has it been growing? As the economies start looking like, let's just make just an exercise in thinking. If all the economies they've been stagnating, maybe, and they haven't been growing as fast as they should be. If all of the economies have not been growing as fast as they should be, and the amount of money has been, the money supply growth has been getting more and more and more, I don't even know what question to ask now. If all the countries in the world are the same, which country would you invest in? There's the question for you. Let's make believe. All the countries in the world are pretty much the same. Very turbulent business cycle, lots of uncertainty. And all of the countries have been increasing money supply, but now they're starting to reduce the growth rate of money supply because all of their economies are starting to show price pressure. So which economy would you invest in right now? There's a good exam question. An exam idea. If most countries in the world have been increasing their money supply growth rate, but now they're starting to reduce the growth rate, which country is the best one to invest in? Or what indicator would you look for a good investment opportunity? Which country? How can you, in other words, how can you tell which country is the best one to move to right now? If you think that Canada is going to have some difficulties in the near future, what would you look for? What indicator? Interest rates, good place to start. What next though? What are interest rates going to tell you? What are interest rates going to indicate? What other co-indicators would you look at? Actually, that's a good place to begin. So you're looking at interest rates. Interest rates, that's a value. We need to start talking about growth. Expansion, contraction. So how fast are interest rates growing? Good place, that's good. How fast are interest rates growing? One country versus another. What do interest rates affect? Spending, yes. But we're going to look at the world now. We're looking at the world. So everyone, pretty much everyone is starting to increase their interest rates. What do interest rates affect when you start talking about the world? How do we trade? It begins with X. Exchange rates. So if interest rates go up, what should happen to the value of your currency? It should go up because people want to have more of it, because interest rates, as soon as interest rates in your country go up, grow faster than the rest of the world, other countries are going to want your debt. So they're going to have to get your currency to buy your government debt so that they can get paid in your currency. And what that's going to do, it makes your currency stronger. So that means exchange rates, your currency appreciates. So there, if you understood that, so what's the answer to my question? Which country do you want to move to right now? The one whose currency is appreciating, because that's the strongest country. The sign of a strong country is the value of their currency relative to everyone else's. What's the United States dollar been doing for the past 6 months? Appreciating against everyone, almost. Especially against the EU, but that's got to do with probably Russia and Ukraine. But historically, what's been the strongest currency in the world? USD. Why? Because they're safe. What was your answer? Largest economy. So what does that mean about the certainty of them repaying their debt? Highly certain that they're going to repay their government debt. Start to get the picture now? Starting to see how it works? If you've got a strong currency, it can become a problem, by the way. Too strong, because I won't get into that. A country what is considered safe is going to have, over the long run, probably lower interest rates, but a higher value currency. The higher value currency indicates certainty, because people want to do, not only do other actors want to do business with them, but it also means demand for their currency is implied. Demand for their currency implies that there's demand for its government debt, which means if people want to invest in the debt of a country, then that means that they believe that country is more certain than other countries. Less risk, therefore, that means more likelihood of investment. Where's my friend? More direct investment in a country, more portfolio investment in a country if it's considered to be a more certain investing environment. So that's why you should see money going into the United States right now, except what goes up comes down, and what goes down usually goes back up. There's a lot of people right now saying that the American dollar has appreciated versus the euro as much as it can, and they start to look at interesting pictures. And they say the dollar's never gone below parity, 1-to-1 with the euro, or in the past 20 years it hasn't. So you know what's going to happen? The American dollar is probably going to depreciate versus the euro. So now's the best time to travel to Europe. because it's going to get more expensive. The euro's probably going to go back up. Where do you want to live? That's up to you. But you've got an idea now. Where do you want to live? A place with a relatively high standard of living, and it's got a relatively stable currency and a relatively stable financial system. Questions? Okay, where do you want to live? You're not sure yet. The U.S.? What would you want to be in the U.S.? Why is that the best option? So you're going to overlook the people who are in charge of the politics. That's another issue, right? It's strong, it's a strong economy. How about you? Where would you want to live right now? Or in the future, where do you think is the safest place for you? The U.S.? Really? How come? You just got a feeling about it? Switzerland. Now we're talking. How come Switzerland? Good healthcare? The environment, except for the flooding last year. I haven't been there. One thing about Switzerland, if I'm not mistaken, they've been neutral, and they changed that with Ukraine. Anyone else want to give me, anyone want to move to North Korea? No? Philippines? Mexico? I have friends in Mexico now, I've been to Mexico. As soon as you hear bang, 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 bang on the beach, I don't want to live there. Okay. That's a little bit of a tangent. But it helps you to understand some of the indicators to look at and why this becomes not just, I'm going to pass the test because I know how to do the math. You can actually use these monetary variables to determine a good place to live or the best place to invest your money. Okay. Money market disequilibrium. At interest rates of IA, this is true and false. At interest rates of IA, there is an excess of money supplied of B minus A. Therefore, nominal interest rates must fall to induce actors to hold more money. You should be able to do this. Is that true or false? At interest rates of IA, there's excess money supply. Is that true or false? At IA, money supply is greater than money, as quantity of money supplied is greater than quantity of money demanded. Is that true? Yeah, it is. At IA, where these intersect, quantity of money supply is greater than quantity of money demanded. Okay. So that means, and how much? B minus A. So B, and if we take it perpendicular down to the x-axis, minus A is excess money supply. So how do we get rid of excess money supply? We have to get people to demand a greater quantity of money. How do we get people to demand a greater quantity of money? Put down the interest rates. Opportunity cost of money goes down. That means they don't have it in the bank, they have it in their pocket. Or another way to look at it, if there's excess money supply in the system, what do actors do with all this excess money? Well, they want to put it into a bank account to get interest. As soon as they try to put it in a bank account to get interest, the banks say, oh, you're demanding more checking accounts. We're going to put down the interest rates. You want more interest? We're going to put rates down until you don't want that. You don't want to put more money into the checking accounts anymore. That's supposedly the way that it works. So the answer is true. The math. So here's what we have. The money demand is a function of the money demand curve. And money demand depends on nominal interest rates. How much money you have in your pocket or in a checking account, that's nominal rates, short term. And the equation of the line is M0D, that will be M0D here, plus the slope of the line, and I did this as M with a slash through it, D, the demand curve slope, and that's going to be times I. We've got I up here. So the equation of this line is going to be M sub 0 D plus the slope of the demand curve times I, where the intercept, that's the x-intercept, is greater than 0, and the slope of the line is going to be the quantity of money demanded divided by the change in quantity demanded, given the change in interest rates. Oops, I forgot to put up here. Money supply is constant. Money supply is constant. Money supply is determined by the Bank of Canada. So there are no factors which affect money supply. The Bank of Canada determines money supply. That's why it's a straight up and down line. That's why money supply is a straight up and down line. Nothing affects it in our model. It's all determined by the Bank of Canada. So the slope of the line, it's less than 0. You've seen this all before when we've done demand curves. So at equilibrium, money supply equals money demand. So the two curves intersect. Where? Well, that's going to be at the equilibrium interest rate. The two curves intersect at the equilibrium interest rate. So that means that money supply minus money demand at the equilibrium interest rate equals 0. So money supply equals money demanded. Money supplied equals money demanded at equilibrium. And that's what this is saying. The quantity of money supplied at equilibrium, M super S star, is going to be equal or minus the quantity of money demanded equals 0. So the two curves intersect. The quantity of money supplied equals the quantity of money demanded at the equilibrium interest rate. So far, so good? Here, what happened? Money supply, but at IA, money demanded was greater than money supplied of B minus A. Or the quantity of money supplied minus the quantity of money demanded was greater than 0. That implies equilibrium. Therefore, money demanded must increase
To do that, we have to decrease interest rates since the slope of the demand curve is less than 0. This must go down because the demand curve slopes downwards for this to increase. So interest rates have to go down for more people to demand more money. Therefore, the statement is true. That's a really long way of saying where the curves should intersect at equilibrium. If we are at a point, if we're at a point above equilibrium, that means quantity of money demanded is less than quantity of money supplied. Therefore, interest rates have to go down, so the quantity of money demanded increases. Therefore, it equals money supplied. If you're at an interest rate below this, then the quantity of money demanded is greater than the quantity of money supplied. Therefore, interest rates have to go up to decrease the amount of money demanded. And you've seen this before. You saw this in week 1, supply and demand. You've seen this last week. You're seeing with actual versus planned expenditure. You're seeing the same kind of thing, how you get to equilibrium. So now we look at money market dynamics. All else equal, economic expansion results in an increase in purchases of goods and services, and this leads to an increase in nominal interest rates. Does that sound right? Does that sound right? As an economy expands, more goods and services are purchased. This leads to an increase in interest rates. So as an economy expands, something in the economy causes interest rates to naturally increase. And that's what's causing that? What's causing interest rates to slowly increase in an economy that's expanding? Price pressure. What's causing price pressure? Scarcity? Actually, yes. Scarcity of what? Oh, but wait, the economy is expanding. How can there be a scarcity of goods and services? Inflation, but that's what he said.
FOP, factors of production. It's labor.
So you've got, okay, let's take a step back. So first, when an economy expands, what's increasing? The factor rents. The amount that more people are making more. So employment's going up, so there's more money going into more pockets, so more stuff is being bought, so more people are being paid, so more stuff is being made, so more people are buying more, etc., etc., etc. So there's pressure from expansion of production. That's going to end up leading to scarcity. But why would interest rates go up? Take a step back. The economy is expanding. So that means that more people are buying more stuff. To buy more stuff, what do you need? More money supply. More money supply. More money supply. What happens if you don't have more money supply? You have more money demand. More people want to buy more stuff. That means they need more money in their hand. So what's happening to the money demand curve?
Shift left.
That's shifting. What does that cause? Is money demand shifting to the right or to the left?
To the left.
People need more money at all interest rates. People need more money at all interest rates. It's shifting to the right. So then and if we have a static amount of money supply, what's going to happen to short-term interest rates? They're going to go up. Why? People want to buy more stuff at all interest rates. They need more money. Show me the money. But there's not more money in the system. So that means they start to bid up the price of money because everyone wants to get that Benz AMG. Everyone wants to get the Benz AMG. Everyone needs the money to buy it. Problem is, there's not more money in the system. So if everyone was trying to get as much money as possible to go on a buying spree, what's got to happen to the cost of money? Price has got to go up. More people want more money, then the price of it has to go up, given a static amount. Money supply is constant. Money supply is constant. Money supply is constant, and more people want to buy more stuff, and it's the whole economy, the price of money has to go up. Short-term price of money. We just solved this without doing any of the math or drawing any pictures. But being able to do the pictures is the important part.
So, what does money demand depend upon? Well, it depends upon real GDP, price levels, and the level of financial technology, fintech. Money demand is increases in real GDP, increases in price levels, and decreases in fintech. Financial technology, that's like having a cell phone with access to a payment system in the sub-Saharan Africa. Look that up. Sub-Saharan Africa has expanded radically because they've had cell phones and the ability to do transactions with their cell phone. It's amazing what's happened. Okay, so let's call the bottom I star, the top one I prime. We'll call this MD prime. And if it's shifted up, that's because one of our constraints have increased or decreased. Here it's increasing purchases of goods and services. So is that increase fintech, PL, or RGDP? What's changed for MD prime, the green demand curve? Which variable? RGDP, thank you. And has it gone up or down? Up. It goes up, money demand increases in it, so that means the curve is shift from M sub 0 D to M sub 0 D prime. So without doing any math, as long as you understand that money demand increases in real GDP, increases in inflation or price levels, and decreases in fintech, you're good to go. Or if you can remember, if more people want to buy more stuff with a constant amount of money supply, then the price of money has to go up. If we go down to the math part, money supply is constant. In other words, it's exogenous. Exogenous, XO outside the system. It's outside the system. Quantity of money demanded is a function of the money demand curve, and that depends on I. And it's given by this equation, where the intercept is greater than 0, and the slope is equal to the rise over the run. It's less than 0 because it slopes downwards. All of the other variables. Quantity of money demanded increases in real GDP, price levels decreases in fintech, or I should say that's the x-intercept. Where? So another way to put it, instead of writing the pluses and the minuses, is to say the intercept is proportional to, this is lowercase sigma. Yes, you get to learn some Greek today, my friends. Sigma times our GDP, where sigma is sigma less than or greater than 0 if the intercept increases in real GDP? Is sigma greater than or equal to 0? Greater than or less than 0? Greater than. Greater than. Greater than. The intercept is proportional to, this is lowercase rho, that's like a backwards p, times price level, where rho is greater than or less than 0. Greater than. And we have omega, uppercase omega. For fintech, is omega less than or greater than 0? Less than. Questions? It's just another way to state the same thing, only I'm showing you how to do it in math. For those of you in engineering, or all of you going on, further on, this stuff is going to be useful. Maybe. So, then at equilibrium, E star. E star. I'll put this E prime here, okay? At E star, quantity of money supplied is equal to quantity of money demanded. So it's going to equal to the equation of the money demand curve at I star. So at E star, quantity of money supplied is going to equal to the quantity of money demanded. That's quantity of money demanded at I star. E star, I star, quantity supplied equals quantity demanded. So the two curves intersect. That's how you write it in math. Okay, or rearrange it. I star is equal to quantity of money supplied minus quantity of money demanded divided by the slope of the money demand curve. You're saying, where's he going with this? Then we have an increase in real GDP. What does that do? It shifts the money demand curve. It shifts the intercept from MD sub 0 to MD prime sub 0. So that's just saying MD curve shifts right. Money supplied equals money demanded at equilibrium. You've probably already put this in your notes. So, the new curve. Well, it's shifted to the right. That means that D prime is greater than MD. Since sigma was greater than 0, because our GDP increased and the parameter on that is positive. So money demand increases in real GDP. Well, the new equilibrium, E prime, quantity of money supplied is equal to quantity of money demanded Forgive me. We're at a new interest rate. It's not this. Why is that incorrect? Why is that incorrect? Because the slope didn't change. Very good. Very good. Slope didn't change, the intercept changed. So we're at a new interest rate. We're going to have a new interest rate because supply didn't change, slope didn't change, but the intercept changed. Because the intercept changed, that means we're going to get a different interest rate because supply didn't change. Or to rewrite it, I prime equals ms minus md naught divided by slope. So what do? Subtract. We subtract one interest rate from the other. Why are we doing this? Because we're trying to prove that interest rates have gone up. So we subtract the new interest rate, we subtract the equilibrium interest rate from the new interest rate, and we see, can we prove that it's positive, meaning rates have to go up. That's the reason I'm doing this math. You subtract the old equilibrium from the new one, and if we can show that it's positive, that proves that interest rates have gone up because our GDP has increased, causing money demand to shift upwards as well. So, MD prime minus. So I've taken this, and I've taken this. Okay, you've got that? Here's the tricky part. And by the way, this took me about 20 minutes to do at home because the algebra gets really, really tricky. So you do it one step at a time. Okay, so I prime minus I star is equal to, okay, take out the d's, take out the slopes. Put that there. What do we have left? ms minus md prime. That's the easy one. Now the tricky part is making sure that you multiply the minus sign across. So what's the next one? We've got minus times minus gives us plus. But that goes here. Minus times here is minus. I almost got that wrong right in front of you. Be careful with this kind of stuff, my friends. All of a sudden, I'm reliving my days in university when I was getting my master's, having to do algebra. Oh, God. One thing, when you're doing algebra, don't write small. write big, because you know what happens when you try to save money on paper? You make foolish errors because a minus becomes a plus becomes a minus because it's too small for you to see. I've done it. Okay, from here, well, look what happens. This gets crossed out. This, because of that. And you've got, I have to do some algebra here, MD minus MD prime times 1 over the slope. Okay? You always put the negative last. You don't put the negative at the front. Well, what do we already know? MD. What's the inequality? The slope. What do we know about the slope? Less than 0? Yeah, I like this. I'm seeing this like, yeah, that's right. It is. It's this way. It's negative. What do we know about MD minus MD prime, the intercepts? Couldn't hear you. Less than or greater than?
Greater.
Really? Which one's bigger, D prime or D? D prime. Which one's on the right side? Therefore, less than 0. Hey, this is why you write in big letters. This is why you learn to draw images neatly, unlike my video images, which are not so neat. This is why you learn to draw the pictures and to understand the pictures, because something as simple as a less than or greater than sign could come in handy in the future in more advanced courses where you have to actually do a mathematical proof. So, if the slope is negative, so that's negative, and this is negative, what's this then? Positive, therefore the statement is true. And yes, all you really have to do is draw the picture accurately, and you can come up with the statement is true. You don't need to do the math for the test or anything like that. But now you do know how to do it. Questions? You should be able to do this. Real GDP goes up, real GDP goes down. Price level goes up, price level goes down. FinTech increases, FinTech decreases. Dynamics. Here's a good final exam question, or something similar to this. The economy's in recession. Oh. The Bank of Canada increases liquidity. This leads to a decrease in interest rates. Consumption increases because the opportunity cost of money is lower. Investment increases because the real cost of investment declines. Net exports increase because the Canadian dollar depreciates. This causes the AD curve to shift right, resulting in real GDP and price levels increasing. Okie dokie. Let's do our labels. Okay. So, interest rate on money market. The top one is I star, bottom one is I prime. That means we've gone from equilibrium of E star to an equilibrium of E prime. And the quantity of money down here is M sub E star. Let's look at the economy in Canada. We start at equilibrium of E star. That's at a price level of 98 and real output of 1.3 on the AD curve, SRAS curve. And we end up at AD prime at a new equilibrium of E prime. So, I'll give you a second to get your colors. Okay? Everyone's graph is complete. So, what's happened here? This is the story you should be able to go through in your mind. The economy's in recession, which means we have unemployment, which means that we have a short-term equilibrium. Short-term equilibrium. Short-term equilibrium is a short-term equilibrium ever on full output, or long-run aggregate supply, or PGDP, is a short-run equilibrium. I shouldn't ask this, but as far as we know, it is a short-run equilibrium ever on, where is a short-term equilibrium ever when all three graphs intersect at the same place. Now, that's the long-run equilibrium. Okay. So recession, we have a short-term equilibrium where output is less than full potential. So that's SRAS and AD. You have an RGDP of 1.3 as opposed to a full output of 1.4, which is long-run aggregate supply, at a price level of 98. We start with money demand intersecting money supply at an equilibrium interest rate of I star and a quantity of money supplied of M sub E star. So, we're in recession. Excuse me. What does the government do during recessions? Do they want to put more money into the system so that people take that money and spend it? Or do they take money out of the system so that people spend less? There's a good place to start in your analysis. We're in a recession. What does the government want people to do? Or the Bank of Canada, or the smart people that are creating policy. We're in a recession. What do you want people to do? What do you want businesses to do? Spend more. How do you get them to spend more? And invest more. It's more invest more, actually. You want to reduce interest rates. How do you reduce interest rates? If you can't change money demand, monetary policy, more money, increase the money supply by performing open market operations, buying short-term debt, buying government debt back from the banks so that you're putting more money into the system. There you go. What ends up happening? The curve shifts from MS to MS prime. At the old equilibrium rate, quantity of money supplied is greater than quantity of money demanded, so therefore interest rates have to come down for that excess money to be taken up. What does this do? Well, what does aggregate demand depend upon? Well, actually, aggregate demand is aggregate expense given changes in price level. Aggregate demand is aggregate expenditure given changes in price level. Okay, what's aggregate expenditure? CIG and X. Okay, consumption. What does consumption depend upon? Interest rates. A little bit. If you have lower interest rates, what ends up happening, part of consumption that increases, you get some people spending a little bit more on pizza and coffee and textbooks, but more of it has to do with the amount of consumption that goes into investing or buying new homes. So it's really investment. They don't really talk about that in the textbook, they just say consumption goes up a little bit because people have more money in their pockets. So with interest rates going down, there's some more consumption. But where it really affects is investment, planned investment. Planned investment decreases in interest rates. So interest rates go up, planned investment goes down. Because the cost of finance, long-term finance, is going up. Even though this is short-term, these are short-term rates. This is short-term nominal, but nominal plus inflation equals, oh wait, nominal plus inflation equals real? Nominal plus inflation equals real? What's the equation? Real equals nominal minus inflation, or nominal equals real plus inflation. So if short-term rates go up or down, that's going to affect long-term rates. Because long-term rates, real rates are equal to nominal minus inflation. So if nominal goes up or nominal goes down, that's going to directly cause real rates to go up or to go down. So if nominal rates go down, that means long-term rates are going to go down. That means it's going to, and since investment decreases in long-term rates, and long-term rates are going down, that means investment is going to go up in theory. The next thing, so that's two things that are affecting aggregate expenditure. The next is net exports. Well, if interest rates go down, what happens to the value of the Canadian dollar versus everyone else's? Well, are people going to want to buy our government debt as much? No. So they don't need as much Canadian money. They don't need as much Canadian money. So what ends up happening to exchange rates? The dollar depreciates. All of a sudden, if the dollar depreciates, then foreigners that are buying our goods, they have to pay more or less for the same amount of goods if the Canadian dollar depreciates versus all of the other currencies in the world. So take a second, this is really tricky. So the Canadian dollar has less value than before versus all the other currencies in the world. And people that are buying from us, our exports, they think, wait, Canadian maple syrup, Canadian pizza, whatever. Let's see, the Canadian dollar has gone down versus our money
So what are we going to do? Buy more or buy less? Because we buy more, we're going to have exports increase because what's changed? Because the dollar has depreciated, or all prices relative to what they were have gone down. Because if it, well, stop. Who does understand? Really? Okay. Just think about it like this. Yeah. Interest rates have gone down. We don't want to buy your debt anymore. That translates to exchange rates going down, which means if it costs you $1.50 to buy a pizza, if it costs you 150 quatlus to buy a Canadian pizza, now it only costs you 100 quatlus. Quatlus is your home currency. So all of a sudden, prices have gone down because the Canadian dollar is depreciated. So that's why you go to Europe now, because the euro is down versus the US dollar and the Canadian dollar. So it costs you less to buy the same amount of goods and services in Europe than it did 6 months ago. On the other hand, if prices in Canada have gone down because of exchange rates versus the rest of the world, what's happened to the cost of buying a pizza in Chuckistan? It's gone up. If the Canadian dollar has depreciated versus all of the other currencies, that means you have to spend more Canadian dollars to buy stuff in other countries. So that means imports go down, exports go up. That means net exports go up. So net exports up, investment up, consumption up, means AE curve shifts up. And since price levels haven't changed, that's going to shift the AD curve outwards. So an increase in money supply ultimately leads to an increase in aggregate demand through consumption, investment, and net exports. And miraculously, we're back at equilibrium. Which, by the way, never occurs. Why? Because we're always on different growth trajectories. It's all about growth. What we're looking at here is a really simplified way of looking at it, but you understand. Now you understand why do you want to take a trip to Europe next week? Because the euro is cheaper relative to the Canadian dollar over the last 6 months. So that's the story here. The math. Long run aggregate supply is the maximum output of the economy. Money supply is constant, meaning it's exogenous. Okay, so quantity of money demanded depends on interest rates. Money demand curve equation, excuse me. Intercept is greater than 0 on the money demand curve. Money demand slope is equal to change in quantity money demanded by change in interest rates, and that's less than 0. Money demand is downward sloping. So we're in a recession. The Bank of Canada buys in the open market. That increases the money supply from MS to MS prime. So that means we have excess money supply at the old interest rate of I star.
Another way to say that is that the quantity of the money supply is greater than the money demand at I star. Or mx minus m sub e is greater than 0, eb sub star. So there's excess money supply at the old equilibrium rate. Now, since quantity of money demanded given by this equation, this implies, given that money demand is downward sloping and that we have excess money supply, that means interest rates have to decrease I to I prime, or actually I star to I prime. And this implies that aggregate demand is going to increase from AD to AD prime. Why? The decrease in rates causes a decrease in the incentive to save. So people are going to save less. That means they consume more because consumption decreases in rates. It means there's a decrease in the cost of long-term finance. So that's going to cause planned investment to increase because planned investment decreases in real rates. This is going to decrease the cost of Canadian goods versus the rest of the world. And that's going to cause exports to increase because exports decrease in exchange rates and exchange rates increase in real rates. That's going to be an increase in the cost of the rest of the world goods versus Canadian, which is going to decrease imports because imports increase in exchange rates and exchange rates increase in real rates. And what does this mean? It means that we have a shift. All of this shifts the AE curve from, and I don't have it here, but I'll just call it AE to AE prime, where AE prime is the new AE curve with an increase in consumption, investment, and net exports, and a decrease in imports. I did net exports separate to show that exports go up because exchange rates went down, and imports go down because the dollar depreciated. And this is all with prices being constant. Aggregate expenditure is going to shift up. Prices remain constant. Prices remain constant, AE shifts up. What happens to AD curve? It shifts out. From AD to AD prime, therefore the statement is true. All good? This is exactly the opposite of what's happening now. They're increasing rates to slow down on demand. The problem is everyone else in the world is doing it too. So how can you possibly know what's going to happen with exchange rates? That's one problem that's going on in the world right now. Then you start to look at government debt, how much debt has increased over time. Any questions here? Yep.
What does the horizontal line above the R mean?
Decreases in. So consumption decreases in real rates. As interest rates go up, consumption goes down. Actually, it shouldn't be R, it should be I, but these are all long term, so this would be consumption. Good question. For consumption, real rates. It's not got anything to do with spending money in your pocket on pizza. It's more about buying durable goods like a car or a washing machine or a new home. That's more what we should be, that's more of the concern here. Real rates affect consumption in long-term assets. That's the way to look at it. Because if we got into how do nominal rates affect consumption, then we would have to look at the curve, actually, the consumption curve, the slope changes. Because you're looking at marginal propensity to consume is affected by interest rates. And I don't want to get into that, but you got me? Okay. Aggregate expenditure, prime, consumption increases in rates, planned investment decreases in rates, planned investment decreases in interest rates, exports decrease in exchange rates, imports, that should be plus. Imports increase in exchange rates. Forgive me. Imports increase in exchange rates. If the value of your home currency appreciates versus the rest of the world, you're going to import more because everything in the rest of the world is relatively cheaper. Or another way to look at it, if the Canadian dollar appreciates, do you buy Amazon.ca or Amazon. Rest of the world? You buy the rest of the world because it's all gone down relative. And I think, we're on the last question. Yay. The economy is at equilibrium. The price of oil increases dramatically. This causes price pressure, a decrease in output, and an increase in unemployment. The central bank increases liquidity. This causes inflation, an increase in output, and a decrease in unemployment. Our curves, okay. We've got SRAS prime, AD prime, E star, E prime, S plus. Then we have MS, MS prime, I star, E prime, ME star. Okay? Okay.
So we go to long run aggregate supply is the maximum output of the economy. Money supply is constant. Money supply is exogenous. And you've seen all of this before. MD is equal to, or quantity of money demanded is equal to money demand at I star equilibrium, which gives us, oops, not I star, just I. Quantity of money demanded is a function of money demand given interest rates. The equation of the line, where the intercept is greater than 0. The slope is given by the change in quantity of money demanded divided by changes in rates, which is less than 0 because money demand is downward sloping. Real GDP supplied depends on all these things. Real GDP supplied is a function of the short run aggregate supply, and that's given by the line, real GDP sub 0, plus the slope of the short run aggregate supply curve times price level. And the slope of the supply curve, the slope of the short run aggregate supply is greater than 0. And what we're talking about here is the price of inputs. So what's an input for making orange juice? Oranges. What's an input for making pizza? Flour. Here, price of oil's gone up. If the price of inputs increases, what happens to supply? It decreases because you can't make as much profit given the price of your inputs. So supply decreases. Bless you. So short run aggregate supply decreases in the price of inputs. So that makes the parameter on the price of inputs, rho, less than 0. So the price of oil goes up. That's going to decrease short-run aggregate supply from SRAS to SRAS prime since rho is less than 0, or since SRAS decreases in price of inputs. And that's going to give us what kind of pricing? Is that going to cause soft prices or price pressure if supply decreases? Short-run supply decreases, so there's less stuff to buy. What should happen to prices as people compete to buy what's remaining? Price pressure. Good. Since short-run increase in prices. This is short-run. It's pressure because it's short-run. Price pressure because it's short-run. Price levels go from what to what? 100 to 103. And there's been an increase in unemployment since there's been a decrease in real GDP from 1.4 to 1.3. As soon as real GDP decreases, people become unemployed. And there's price pressure. So not only are people losing their jobs, but there's upward pressure on the price of pizza. People are not happy in this country. So what does the government do? They buy back debt. This increases money supply from MS to MS prime. Now there's excess money supply. at the old interest rate of I star. That's to say that quantity of money supplied is greater than quantity of money demanded at I star. Or mx minus me star is greater than 0, excess money supplied. Since the quantity of money demanded at given I has a slope of less than 0, this implies interest rates have to go down from I star to I prime. This is going to increase aggregate demand from AD to AD prime for all the same reasons as the last question. Decrease in rates, increased incentive to save because of an increase in C because consumption decreases in R. Increased cost. Oops. Forgive me. Decreased incentive to save means increased consumption. Decreased cost of long-term finance causes increase in investment because investment decreases in R. Decreased cost of Canadian goods versus the rest of the world means that exports increase. Exports decrease in exchange rates, and exchange rates should be decrease in R, Chucky. No, it's increase. And an increase in the cost of rest of world goods versus Canada means that imports decrease because imports increase in exchange rates and exchange rates increase in real rates. This means that AE increases from AE to AE prime because consumption increases, planned investment increases, exports increase, and imports decrease given constant price levels, which is another way of saying the AD curve shifts from AD to AD prime. It shifts to the right. This decreases unemployment because real GDP is increased from 1.3 to 1.4. And now we don't have just price pressure. Now we're back at a new equilibrium. At a higher price level, that's inflation. We move from one long-run equilibrium to another long-run equilibrium, and price levels go up. That's inflation. If we go from equilibrium to a short-term equilibrium with price levels going up, that's not inflation. That's price pressure. Positive or negative. Short-run price pressure means short-run equilibrium, change in price levels. Inflation means long-run equilibrium to new long-run equilibrium. That's inflation or deflation. So inflation we've gone from 100, a price level of 100 to 105, which means we have inflation of 5%. So since we have a new long-run equilibrium at full output plus higher price levels, which implies inflation, statement is true. The last two questions are representative of the final exam. So, I hope to see you next week. I'll email or I'll leave an announcement if we're on strike on Friday. I'm not sure what's going to happen, but you'll be okay, one way or another. If you're passing now, you'll pass. Unless you do something stupid. So don't do anything stupid in the next 2 weeks. Keep doing what you're doing. Keep this in mind. Central banks use interest rates to offset shocks to the system. The thing about shocks to the system is we're dealing with a dynamic. We're dealing with a growth model. Let me say this, I'll put it to you this way. I think I know what I'm going to do after I leave this class, but I have no idea what the economy is doing right now. So what do I do in my spare time? I increase something. What do I increase in my spare time? HK. Hope to see you next week. Office hours start now. Yay, we got done almost on time this week. Thanks for coming. I'll have these videos online sometime.
Can we go back to the last page of notes?
Mm-hmm.
On the page before summary. So, if the real interest is going up, like we are supposed to have an increase in exchange rate, right?
Yes.
So why right going down?
Well, that's imports are going down. Exchange rates increase in rates.
Oh yeah.
Exports decrease in exchange rate.
Oh no.
Okay?
Okay.
Yeah, that's
I didn't understand the note at the first place.
So what I should have done is I should have made an arrow to there and then an arrow to there.
Yeah, I see.
Welcome to calculus.
Yeah, I just want to have one more question
Yep.
about money. So, like, do you distinguish between money and currency?
Currency is what you have in your pocket.
Yeah.
Money is deposits, loans, and money in circulation. So it's money in the pocket, and it's checking accounts,
Yeah.
and it's loans.
So, is currency considered as asset?
No.
No.
It's just an easy way to exchange work for goods and services, and some other things. But keep it simple. Why do we have money?
To use it as intermediate way of trade.
And the reason is because of a thing called something of wants.